back 12 minutes after. Jim Corridore, airlines analyst over at Standard & Poor's, says that though demand is weak right now and pricing has come down for flights, airlines are still getting the benefit of sharply lower jet fuel prices. Well, join us right now from Standard & Poor's offices in New York is Jim with his outlook for the airlines. Jim, good afternoon.
Hi, how are you?
I'm doing okay. You know, what strikes me when we talk about the airlines is I'm amazed up to this point how they kind of managed to get through the last 8, 9, 12 months without all filing bankrupt. How did they do that?
Sure. Well, investors have been very focused on how bad the traffic numbers and the passenger demand numbers have been. What they've been a little less focused on is just how much relief they're getting from lower oil prices and jet fuel prices. I mean, it was July 11th last year, almost a year ago to this date, that oil hit its record high above $147 a barrel. And as we're sitting here today, we're under $60 a barrel. So while we're predicting that revenues will come in across the group about 20 to 25% lower, their largest cost category, jet fuel, is going to be over 60% lower. So that's providing them with sharp relief and is mitigating the amount of cash burn that they're experiencing right now.
Jim, you went through a lot of numbers right there. Go back over that revenue number. So 20 to 25% decline in revenues for the latest quarter?
Sure. That's reflecting the drop in passenger demand as well as lower pricing because airlines are cutting airfares right now.
How much worse is that from what you originally expected?
Yeah, I believe starting on the year, as the economic recession was really undergoing and was not really as bad as it is right now, we were expecting about a 10 to 12% decline in revenues. So that's probably twice as bad as we were earlier expecting. But we were expecting, as summer came along, for oil to start creeping back up. And yes, I mean, it's up from its lows, but still well below where we were expecting it to be this time of year.
Now, Jim, help me out, because from what I understand, the second quarter is supposed to be one of the airlines' best quarters when they generate lots of cash, and it kind of helps them get through the lean winter months. I mean, that's not happening, or it doesn't look like that's happening this time around. What does that mean, then, potentially, for the outlook for these carriers?
Certainly, those carriers that do not have large cash resources, as we get back into the winter this year, and they do start experiencing the normal seasonal cash burn, they may have a little bit more trouble than those that do have adequate cash balances. So there are some that are particularly strong right now. They've been able to pad their cash balances by refinancing when they could and just basically building cash when they could.
All right, I'm thinking Southwest falls into that camp?
Southwest certainly has enough cash. They've got over $2 billion. They're a smaller carrier than the Deltas and Uniteds of the world, and very healthy balance sheet with a low debt-to-cap ratio. So they should be fine.
All right, so Southwest should be fine. Who else should be fine, Jim, in your view?
Yeah, Delta's has got close to $5 billion in cash on its balance sheet right now, and the ability to cut more costs than its peers in our view because they're still getting synergies from the merger. So they should be fine. We also think Continental, a relatively smaller size carrier that should have lower cash burn, should be fine as well.
What about those running out of cash? Which carriers are at the greatest risk for running low on cash later on this year in your view?
Well, we do think that Americans, AMR Corp, and U.S. Airways may have some trouble adding to liquidity balances right now. But yeah, they still do have adequate cash. It depends on how much cash burn they do experience during the winter.
I mean, Jim, if they need to raise additional cash, can they do so? And if so, how onerous will the rates be potentially for them?
Well, we saw United have a refinancing that was at an alarmingly high rate as they did a securitization of some of their spare parts that was over, I believe it was over 15% that they're paying. So yeah, right now the credit market is very tight for all companies. Those that are high risk or considered high risk are seeing high interest rates. So it's not a great time to be accessing the capital market right now for airlines.
All right, is it a great time at all to be even thinking about investing in these airline names? I'm looking at the group overall down about 23%, down 12% since early May.
Well, we think, first of all, there is going to be some improvement in travel demand moving on through the rest of the year. And those airlines that are going to be long-term survivors are going to do well over the long term. I mean, we're not going to see a total absence of air travel in this country and in this industry. So there are going to be survivors. We have buys on Delta, Southwest, and Continental right now. We think that they're long-term survivors.
And they've certainly cut a lot of the costs out of the equation. I'm thinking about reducing capacity within the industry. That's come down way big time.
Yeah, we saw a lot of domestic capacity come out of the system late last year, early this year, and as winter rolls around this year, we're going to see a lot of international capacity come out. That should help pricing on that scale as well.
All right, we'll keep a watch for that. Hey, Jim, thank you so much. Jim Corridore over at Standard & Poor's breaking down the airline industry for us.